Preparing financial statements is an important part of the accounting process. And once the financial statements have been prepared, managers, owners, lenders, investors, and other stakeholders use them to evaluate a company's financial performance and financial position. In this video, we'll learn how accountants interpret financial statements and use financial metrics and ratios to gain insights into a business. These tools help answer important questions such as, is the company profitable? Does it have enough cash to meet its obligations? Is the business growing? And how does its performance compare to prior years or competitors? While many organizations rely on common financial ratios and performance measures, some industries also use specialized metrics tailored to their unique operations. For example, startup companies often focus closely on cash flow and the burn rate, the speed at which they consume available cash. And in the healthcare industry, a common metric is PMPM, or per member per month, which helps organizations evaluate revenue and healthcare costs on a per member basis over time. In the mortgage industry, a common metric is cost per loan. In this introduction to accounting class, we'll focus primarily on the financial statement for one accounting period and the related financial ratios. However, most companies compare the current period financial statements to prior periods to see how performance has changed. In addition, companies also compare the current period financial statements to the budget and forecast to understand where the results came in higher or lower than expected. Many companies also prepare income statements by legal entity, region, department, and project to allow financial analysts to really understand the results. And it becomes very interesting when you use data analysis tools like Tableau or Power BI to visualize and analyze results. Interpreting financial statements is the ninth step in the nine-step accounting cycle. What does it exactly mean to interpret financial statements? To interpret means to understand and explain the meaning and importance of something. And there are many people who want to understand the company's financial statements. For instance, the owners or managers of the business, but also investors, employees, creditors, customers, and tax agencies, because the financial statements help users make all kinds of decisions. Many accountants prepare a variance analysis worksheet before finalizing the financial statements. Here's an example of a variance analysis worksheet the accountant might prepare to review variances for quarter-to-date and year-to-date actuals versus the budget. Typically, the accountant would also add variance explanations for any variance above a certain threshold. Here I've used plus minus 10%, but in many companies, the variance threshold is a combination of a dollar variance and a percentage variance. For example, it might be a variance of $50,000 and 5%. In a separate column, the variance explanation is entered so that it is apparent that the accountant has looked at the variance, has an explanation, and that there aren't any missing entries. In addition to a comparison to a budget or forecast, the accountant also typically prepares a trend comparison by listing the past 12 months of a trial balance and analyzing whether any significant fluctuations exist, and then lists the explanation. So now let's talk about the financial statements. What we have here is Eli's Consulting Services income statement for the month ended December 31st. And the income statement can answer a lot of questions, such as how much did Eli's Consulting earn in net income in December? $33,667. How much would Eli's Consulting need to earn to cover all monthly expenses? $13,333. How much net income does Eli's Consulting earn compared to the revenue? That would be $33,667 divided by $47,000, or 72%. Or to say that another way, for every dollar that Eli's Consulting earned from customers, 72 cents was left after paying expenses. What were the largest expenses of the business? Salaries and rent expenses. Combined, those expenses are $12,000, representing 90% of all expenses. What other questions could we ask? As an accountant, it's important to make financial statements easy to understand for the users of those financial statements. In addition to looking at only one accounting period, in future months, we would want to compare the monthly income statement to prior months and see how the expenses and the revenue differs. There are quite a few ratios that can be used to interpret the income statements. Some of the ratios are gross profit ratio, operating ratio, operating profit ratio, net profit ratio, return on investment, ROI, return on net worth, earnings per share, and book value per share. Some of these ratios only apply to corporations that have issued shares of stock. Next, let's look at Eli's consulting statement of owner's equity. Some of the questions we could ask are, how much did Trayton Eli earn on his investment of $100,000? To answer that question, we would take the net income for the period of $33,667 and divide it by the investment of $100,000, which would be 34%. So at this current rate of net income and assuming continuing net income at the same rate as December, how many months would it take for Trayton to double his capital? Our return on investment for December is 34%, so it would take about 3 months to double his capital, less what Eli draws out of the company. Let's now look at Eli's consulting balance sheet. The balance sheet helps us answer a lot of questions about the company's assets, liabilities, and owner's equity. Ratios are very helpful in analyzing the balance sheet. And some of the key balance sheet ratios are the current ratio, quick ratio, debt to equity ratio, working capital, and solvency ratio. Let's calculate the current ratio for Eli's consulting. Eli's current assets include cash, accounts receivable, supplies, and prepaid rent for a total of $121,350, and its current liabilities include accounts payable of $3,500 for a current ratio of 34.6, which means that the company has plenty of current assets to meet its current obligations. Believe it or not, many large, some well-known companies do not have enough current assets to meet their current obligations. That doesn't necessarily mean that they're close to defaulting on their obligations, but it's worth taking a closer look at other ratios to understand why the company is so highly leveraged in short-term obligations. Although accountants are typically not responsible for the financial statement analysis, the financial analysts often ask the accountants why expenses are high or low, if there was unusual activity or other activity. In my experience, an effective accounting team will prepare financial statement analysis to ensure that nothing was missed during the accounting cycle and to have a ready answer for the financial and budget analysts. In this chapter, you learned how accountants and other financial statement users interpret financial information to evaluate a company's performance, financial position, and overall health. While financial statements provide valuable data, it is the analysis of that data through trends, comparisons, and financial ratios that transforms numbers into meaningful business insights. You also learned that different industries and organizations may focus on different performance measures depending on their goals and operating environment. Whether evaluating profitability, liquidity, efficiency, or growth, financial metrics help managers, investors, lenders, and other stakeholders make more informed decisions. As you continue your accounting studies and career, you'll discover that preparing financial statements is an important part of an accountant's role. Equally important is the ability to understand what the numbers are saying and really communicate those insights to others. Remember, financial statements tell the story of a business, but financial analysis helps us understand what that story means.